This is Mark with the Good Endeavor Short-Term Rental Show. I'm super excited today to welcome Grant Dougherty of Dougherty Tax Solutions. Grant and I actually synced up on Instagram. I've been following his content for quite a while. So have about 73,000 other people. And so I'm super excited today to welcome Grant Dougherty. Grant, welcome to the show.
Hey, thanks, Mark. Thanks for having me, man.
For sure. Man, I have been following your stuff and finally got the guts up to reach out and ask you if you'd be on the show. But it's been super valuable. You put out stuff every single day, and it looks like a lot of other people find value in it too. Getting into the tax profession, can you kind of tell us a little bit about who you are, kind of where you're from, what your family looks like, how you got into this profession?
Yeah, man. So, my name is Grant Dougherty. I am from Houston, Texas. I actually went to school at Prairie View A&M University. I played baseball there. I went there and I played baseball there for 4 years. And while I was there, I studied. I got a degree in business management and a minor in finance and accounting. So that's essentially how I got into the business world. Now, whenever I chose those majors or minors, whenever I was initially going into school, I did not think that I was going to end up doing taxes, right? It was just something that I heard I could make good money in. Let me just go ahead and get an education while I'm playing sports. It wasn't until after I graduated and I then got licensed to do taxes, and I actually started to take the skills that I learned in school and now it actually applied to my real life. Like, okay, now I actually have to file a tax return. Now I have to know what a 401k is. That's when it finally clicked. And, I started my business. It started off very small. I started it in early 2020, and it just slowly grew from there. I had been in the industry. I had worked at a company called Cisco in their finance and tax department. So I had gotten a little bit of background on more of the corporate side of how things work.
Cisco Systems?
Then,
The IT?
no, Cisco Food.
Okay, Cisco Food. Gotcha.
Yeah, it's a food distribution company. It's actually the largest food distribution company.
SYSCO.
Yeah. But you see, what I learned at the big corporate offices is your job is very narrowly focused, right? So maybe there's an entire picture of the entire system that's going on, but whenever you learn things in like corporate finance and corporate tax, it's very narrow and it's very specific to one situation. And so that's when I actually got licensed whenever I was still working there. And that's when I started off very small, taking on a few clients, very simple tax returns. And the more that I did it, the more that I started to study on more. I took on a mentor. I started working with different mentors who then helped me learn more advanced tax strategies and essentially how to actually file that on a return. And next thing you know, my business grew. I started putting content out on social media, and that's essentially how my business started to grow more and more. And now I service, currently I work with over 100 people year round on different tax strategies. And then I have worked with a few more during tax season whenever they just need their taxes filed.
That's awesome, man. So kind of early on or during college, you found out like, I love business and I'm really good with numbers. Like this is going to be my value to the world, right?
Right. I like to make money and I like to make more money. I like to learn once when I learned that you could make money and then take that money to make you more money, I was completely sold on the system.
I love that. And so it sounds like the light at the end of the tunnel for you, and correct me if I'm wrong, might just be to help as many people understand that as possible. Like what kind of drives you? Is that fairly stated?
Yeah, so I love to educate people, and I find it actually it's one of my better skills, right? And I can take a complex situation and break it down into a very basic understanding to where anyone can understand it. And that's essentially how my business is operated. Is most of the people who I work with, they work with me because I understand how to file their tax returns and understand how to implement these strategies correctly. But I also educate them to the point to where they now have the same knowledge that I have on the same topic. Now, maybe that there's like a one-off case situation where, okay, I don't know, hey, is driving, count for material participation, right? They may come to me asking me a very specific question like that. But in general, most of the strategies that we would implement, they have a very good understanding of, and they know what to look for on a day-to-day basis.
Yeah, that's you actually bring up a good point when you mention material participation. In this industry, the short-term rental industry, a lot of folks may have gotten into this for tax reasons alone. Can you touch on
Right.
that? Like, what are some of the tax benefits, or what are the major tax benefits of owning short-term rental property?
Oh man. So before I get into that, we should probably back up a little bit and just cover like general real estate. Real estate itself has a lot of tax incentives to, for people to invest in. Probably, if I had to take a guess, there's probably more tax incentives for real estate than any other asset in the tax code, right? And one of those is actually that the income is passive, right? So passive income is really strategic because it's not subject to some of your active taxes like Social Security and Medicare. So if you take someone with 100K of passive rental income and take someone with 100K of, maybe a W-2 income, or maybe 100K of business income, and this is income after all expenses accounted for, right? The strictly profit, the 100K of passive rental income will be taxed far less than the 100K of this other earned income. Now, the caveat to that though is that there are passive activity loss limitations. So usually whenever you have rental activities, if you generate a loss through things like accelerated depreciation, cost segregation analysis, something like that, the loss is going to be passive. And unless you have income, or it's actually modified adjusted gross income that's less than $150,000 per year, you cannot use any passive losses to offset your income. And that's where the workaround kind of comes into play with the short-term rentals, is that the hurdles that you can jump in order to essentially treat it as a non-passive activity are less stringent. So normally whenever you have a long-term rental, any rental activity, it is considered a passive activity. And if you want to treat it as non-passive, you have to qualify as a real estate professional, and then you have to meet material participation in that property. The workaround with the short-term rentals is that if you have a property where the average tenant stays for 7 days or less, under section 469 of the IRC Internal Revenue Code, the IRS says that you do not actually have a quote unquote rental activity. And because of that, you no longer have to qualify for real estate professional status. You would only have to meet material participation in your short-term rental to treat it as a non-passive activity. And then if you can treat it as a non-passive activity, then if you run a loss through things like accelerated depreciation or cost segregation, that can then offset your other business income, your other active income. It's now a non-passive loss that can offset other non-passive income. So that's the big tax incentive that people look for whenever whenever they decide to invest in short-term rentals. So yeah, no, I've seen some pretty big tax savings through people. Now, there's a lot of meticulous record keeping that you have to keep, right? Because if you go into a strategy like this, anytime you are taking a large loss against your income, that's an automatic eye opener to anyone at the IRS, right? Now, they do understand that there is bonus depreciation and that they understand how rentals work, right? But what if they were to audit you, you would have to definitely, the burden of proof is on the taxpayer to validate essentially what they claim on their tax return. So you have to show that the average tenant stayed for 7 days or less. You have to show with meticulous and contemporaneous time logs that you did meet material participation. There are 7 tests that you can meet one of the. There are 7 tests to material participation. You only have to meet one of them, but your time log must match up with whichever test you are claiming. And there's a lot more, in-depth strategies that I could talk about, but definitely record keeping is probably number one thing that I would say whenever it comes to implementing any type of strategy. Business owners, real estate investors, keep good records. And if you're going to implement a strategy like this, keep even more meticulous records.
Yeah, tell me a little bit more about that. From what I understand, if you have a single property, you have a minimum hour threshold that you need to meet. But if you have multiple properties, and we're talking about short-term rentals, then there's you can do it with I think it's 500 hours. Is that correct?
Yeah, so there, I think you're talking about the 7 material
Yeah.
participation tests. So there's 7 of them, but 3 of them are going to be more commonly used than others because the other 7 are going to like involve like previous years of material
I see.
participation and like different like caveats like that. But the 3 most common is there's the 500-hour rule. It's going to be considered, I've heard it called the golden rule before, or the golden mark, because if you meet 500 hours of material participation, you don't have to track necessarily anyone else's time because you met the 500 hours you materially participated. Now there are other the other 2 tests kind of involve you they're requiring you to track and keep more documentation because not only do you have to track your time, but you would have to track anyone else's time that essentially worked on the property. So the first test is the 500-hour test. The second test is substantially all test, and that's essentially that you perform substantially all of the participation. Now, usually that means that you cannot have anyone else working on the property. So again, you're going to have to just make sure that you document it. And if you do have anyone else that worked on the property, any cleaners, that essentially throws out that test, which then brings up test number 3, which is the more than 100-hour test. And that's essentially you have to meet more than 100 hours of material participation. So 101 is the bare minimum. I always tell people, make sure that, if 101 is the minimum, your goal should be 150, 200 hours, just to be safe. Also track your hours and minutes, track your time in minutes because people have a tendency, if they track it in hours, they're going to round up. And the IRS does not accept estimates. They want very precise record keeping. So track your time in minutes. You can track your time through an app called Reps Tracker. I highly recommend Reps Tracker. Clockify is also a good, time tracking app. So you can just, track your time that way and track it in minutes. That way it's a little bit more precise, more realistic, right? And essentially, if you just meet one of those 3 tests, then you qualify to treat your activity as a non-passive activity if it's a short-term rental.
That's that's great advice. So, um, historically, like I've done this, and traditionally, it's usually like 30% of the property value is depreciable, maybe 20%, depending on
Yeah.
what the property is. And
So
so, real life example, say it's $1 million property, the land is worth 100,000, but real life example, $300,000 of that could potentially be bonus depreciable in year one. That was last year. Now the rules have changed, right?
yeah. So like the way how it works is that anything with a depreciable life of 20 years or less qualifies for bonus depreciation. And whenever you acquire a rental property, any property, uh, and it depends on what type of property. Sometimes you acquire it with furniture, sometimes you don't. But if you acquire a house, it probably comes with a driveway. It probably comes with a patio. It comes with an oven, microwaves. There's all sorts of different things that kind of come with the overall purchase of the house that are not part of the structure of it. And those qualify for bonus depreciation, which is 80% this year. In 2022, it was 100%. And actually, there have been some talks in up in DC, up in Washington, of them trying to bring back 100% bonus depreciation, which would be really huge for a lot of real estate investors, because you can spend more capital, get that money injected back into these other small businesses that are selling these different, for these different businesses that are supporting these transactions
Hmm.
and stuff like that. But we'll see about it. We'll see how. Right now it is currently 80%. Next year it goes down to 60%, and it slowly decreases after that until I believe in 2027 it's completely gone.
Yeah. Yeah. I mean, I tell folks a lot, like I'm not a tax expert like you are, but I, I've lived, I've lived this 100% bonus depreciation for the past couple of years. And the great thing about it is like I can buy a property and almost get that amount of money back that I put down as the down payment, depending on what the income year looks like. Um, so it's almost like you can you can keep buying properties with bonus depreciation money, on your tax returns, which is an incredible strategy. You know, a lot of folks talk about, you know, rehabbing and then refinancing. That's really hard in a high interest rate environment, but
Yes.
this still works. Um, the downside is you don't want to sell that property anytime soon because of the recapture, right?
Yes.
Like, tell us a little bit about that. What is that? What does recapture mean?
That's a really good point. So I always like to say with any type of pro that you would get with any type of tax strategy in the tax code, there's almost always going to be some type of con. And the con to taking bonus depreciation is going to be that depreciation recapture. And essentially what it says is that whenever you claim depreciation on an asset, the government is essentially saying, here, you can get the tax benefit now, but we want this back whenever you essentially sell it and you make more money or whatever the case may be. And that's what depreciation recapture is. And it's taxed as ordinary income, capping at 25%. So you have to be very, very aware of that. Usually, the general rule of thumb is that you don't want to do like a cost seg on a property unless you're going to hold it for a minimum of like 5 years. And generally like the rule of thumb because of that depreciation recapture. So definitely will be very wary of something like that.
I guess the other thing you could do is 1031 exchange into something more valuable. But the downside of that is if you're 1031 exchanging into something more valuable, then the actual bonus depreciation on the more valuable item would have been more, right?
Yeah, so that's another really good point. So 1031 exchange is a great way for a real estate investor to essentially sell a rental property, use the proceeds from that property to acquire another property, and they can avoid some of the capital gains on that purchase. Essentially, they can defer them down to a later date. Now, yeah, you do have to acquire a more valuable property because if you don't acquire a property that's at least equal or greater in value, then you will have to pay some of that capital gains tax. Um, but now the drawback to the 1031, it comes into that cost basis. So your cost basis is what your depreciation is essentially based off of. And whenever you have a property, you're claiming depreciation, your cost basis essentially shrinks. So you have this one property that maybe you claim some bonus depreciation on and you've held it for a few years. Well, that cost basis has slowly shrunk. And whenever you do the 1031 exchange, the government says, okay, you can defer paying this capital gains tax, but your cost basis must transfer over to the new property. Now, if you get a more valuable property, whatever the fair market value of what you sold the property was, whatever excess you paid for it, you do get a bump up in that cost basis, right? So that'll bump up, whatever that excess is, it bumps up your cost basis. But essentially, whatever your really depreciated cost basis was, it transfers over to your new property. So yeah, you don't get as much of a depreciation deduction or even like a bonus depreciation benefit whenever you 1031 into a new property.
Yeah. I like, man, this is great stuff. I like to tell everybody like real estate and specifically short-term rental real estate, like it's really good four-legged stool. Like you get great depreciation, you get appreciation, you get principal pay down, and you get cash flow. Now it sounds great on the surface, but each one of those things requires analyzing and getting professionals like you on your team. Like every single one of those benefits, to maximize those benefits, you're going to need professionals like yourself. I'm sure you get this question all the time. Like, give me advice. Like what kind of property do I want to get? And is short-term rental industry right for me? Do I get a manager or do I manage it myself? Because if you get one, like I guess if you get this narrow focus, like man, I got to get this property for bonus depreciation, and then you start getting phone calls at 7 p.m. on Friday night, and then you try to sell it, like you can end up in a bad spot. So tell me a little bit about like some of the clients that come to you. Like, are you more consultative, or how do you work with folks?
Yeah, so I have a lot of small business owners and real estate investors that come to me. I would say it probably leans more towards the real estate side. I do work with a lot of real estate investors, but I do still have that pretty large base of like small business owners. Whenever I say small business owners, most of them fall under like the $1 million revenue mark a year. Like they're generally where I have a few that go over the million, but most of them are going to be making less than $1 million. And Yeah, man. So, and what I always tell people, because you brought up a really good point, right? It's one thing to, okay, yeah, I'm going to get this property, I'm going to bonus depreciate, I'm going to get all these tax incentives, but there's so much more that goes into it, right? I always tell people, don't let the tax tail wag the economic dog. Number one, you got to make sure it's going to be at least a good property. Number two, what are your goals? Are your goals to create more passive income? Like, you want to receive a check and you don't really have to do much? Maybe you have to talk with the property manager, but tenants can be a nightmare. Like, there's all sorts of nightmare stories out there. And I can even tell you one that's a little bit more unrelated, but what are your goals? And in fact, actually, I'll tie it in. Know where you're investing, right? Understand, okay, am I trying to get into a short-term rental in an area that has been opposed to short-term rentals? Or they tried to ban them? In Dallas, just recently just banned short-term rentals in residential neighborhoods. The little suburb that I live in currently has restrictions on that's probably one of the biggest threats to getting the short-term rentals, that they just say, you know what, no, we're tired of that. We're not allowing that anymore. Now your entire investment plan is kind of like sunken. And understand where you're investing. And actually, I'm not going to talk about that story. I will probably just bring it back around, because I don't want to like make people feel like drag. But there was a client that I all right. So it's actually not my client. It is one of my buddy's clients, and he was like told me all about it. But basically, during COVID, the everything shut down, and there were these renter protections. And I get it, right? Whenever you have like a disaster like that, people aren't making money. Yeah, people who aren't making money, you can't just kick them out of their houses. I get it. But whenever you have anyone, you get someone, some people, if you give them an inch, they'll take a mile, right? And okay, if I don't have to pay any rent in 2020, I'm not going to pay any in 2021. I'm not going to pay any in 2022. So then when the land, when the person who owned the property decided to now evict this tenant in 2023, they took him to court, and the tenant essentially, not only did they win, not have to pay rent for 2023, but they then also countersued, and they had to pay damages for the emotional trauma that they had to go through, right? And they're not paying rent, so understand where you're investing, because you have no idea what the local laws, what they'll do to protect landlords, right? And I get it. There's laws on both sides to make sure that it is an even playing field, right? The landlord should be responsible to make, good living conditions for the tenants. But at the same time, if the landlord can't make any money to pay for it, you want to make sure that the local laws around that do support you being a landlord
Yeah.
there. So I'll just leave it at that. I won't mention
No,
where this
that's,
actually happened.
man, that is really good, because I find that people get into this and they do let the tail wag the dog a little bit from a tax standpoint. And so, because you can't get into the short term rental industry and not manage yourself and meet the thresholds for the bonus depreciation. If you get in it and you hire a manager, you're not going to meet the threshold. So, unless you have a heart for hospitality, unless you plan on putting in the work and answering those messages when you're, I tell people all the time, like, right when you want to spend the most time with your friends and family, that's when people need you the most. They're not going to call you on
Right.
Wednesday afternoon. So before you like go and try to take all these tax savings, make sure you're cut out for this. It's like the IRS views this as a hospitality business, and there's real estate on the side.
Yeah, no, definitely. Again, a lot of tax incentives for it, but like you said, there's so much more that goes into it than just the tax
Yeah.
perks.
Man, this has been super educational, and I encourage anybody out there, if you just want to learn more about taxes, follow Grant on either Twitter or Instagram. Grant, tell us what your handles are on each of those, and how people
Yeah.
might get in touch with you.
Yeah, so my Instagram handle is Dougherty Tax Solutions, Dougherty Tax Solutions. That's my Instagram. On Twitter, they make you have a shorter handle, so it is just my name, Grant Dougherty, but it is at DOU Tax Solutions on Twitter.
Awesome. And you have a website folks can contact you?
Yeah, you can just go to DoughertyTaxSolutions.com. You can fill out if you want to work with us year round, you can fill out a survey, fill out a consultation request, and you'll get notifications on what the next process is to do after that.
That's awesome. And we'll put all this in the show notes as well. Grant,
Awesome.
this has been great, man. You're a stud. You've got it going on, and we appreciate you joining.
Appreciate it, Mark. No, it was a pleasure. It was a pleasure to hop on here, man. Thanks for having me.
You're welcome.